Oil prices could skyrocket to $180 a barrel. Are your investments ready for the impact? Welcome to Profit in Peril, where we cut through market noise to deliver the insights that matter. Today we're dissecting a common myth, that oil prices dictate the stock market's fate. Spoiler, it's more complicated than that. And remember, this is not financial advice. Ever since tensions ignited in Iran, oil prices have been on a tear, with USO climbing 3.47% to $121.43. The upward trend has been driven by a combination of geopolitical instability and supply chain disruptions. Meanwhile, traders are hedging with mounting short interest in the United States oil fund as prices break the $100 barrier. The narrative seems clear: rising oil spells doom for stocks. But that's an oversimplification. Historically, the S&P 500's reactions to oil shocks have been mixed. For example, during the oil crisis in the 1970s, the stock market experienced significant downturns. But in the early 2000s, rising oil prices coincided with a market rally. Yes, higher oil costs constrain businesses by increasing operational costs, but they can also signal robust economic activity, driving profits in energy firms. Moreover, sectors like technology and consumer goods might experience volatility, but others like energy and industrials could see a boost. Let's pull up the candlestick chart on USO. Notice the recent uptick? That's driven by geopolitical tension and supply concerns. But look at the S&P 500 side by side. Last week's upswing didn't falter despite oil's jump. Investors aren't fleeing, they're recalibrating. This suggests a level of confidence in the underlying economic fundamentals, despite the external shocks. The recalibration involves shifting investments from oil-sensitive sectors to those less affected, like utilities or healthcare. Understanding these market movements can provide insights into broader economic trends and investor sentiment. Why doesn't the S&P 500 always tank with rising oil? Consider this: U.S. oil production has surged, cushioning the blow of higher prices. As the U.S. became one of the world's largest oil producers, the domestic economy has become less vulnerable to foreign oil price shocks. Plus, energy stocks are a significant S&P component. When oil prices rise, these giants profit, often offsetting losses elsewhere. Take ExxonMobil and Chevron, which can see substantial earnings increases during oil price hikes. On the flip side, companies like Amazon and Apple face cost pressures from higher oil, but their growth narratives remain strong, driven by innovation and market expansion. Let's not forget gold. Often seen as an inflation hedge, gold prices tend to rise during periods of increased oil prices, providing an alternative investment for risk-averse investors. But here's where it gets dangerous. High oil prices can lead to inflationary pressures, prompting central banks to tighten monetary policy. This can increase borrowing costs and slow economic growth, affecting consumer spending and corporate profits. Furthermore, emerging markets, heavily reliant on energy imports, could face severe economic challenges, leading to global financial instability. The interplay between these factors creates a complex market environment, where investors must carefully balance risk and reward. Compare the sector heat map. Energy's in the green, but tech and consumer sectors are mixed. This isn't a uniform story. The interplay between sectors is what fuels the S&P's resilience. Watch how different industries react, and you'll see why oil isn't the sole market puppet master. For example, the transportation industry, heavily reliant on fuel, may suffer, while renewable energy companies could attract increased investment. This dynamic showcases the importance of sector diversification in investment strategies. Investors must be vigilant about sector-specific risks and opportunities as oil prices fluctuate. Here's the urgent risk. If oil hits that $180 mark, the ripple effects could be severe. Inflation might spike, squeezing margins across industries, particularly those with high energy dependencies. The Fed could respond with rate hikes, throttling growth sectors such as technology and real estate. Furthermore, high oil prices could exacerbate existing geopolitical tensions, creating uncertainty in global markets. Countries heavily dependent on oil imports may face balance of payment crises, leading to currency devaluations and increased debt burdens. The market's cool demeanor can only last so long in the face of relentless pressure. Investors should also consider the potential impact on consumer behavior, as rising fuel costs could reduce disposable income, affecting sectors like retail and automotive. The interconnectedness of global economies means that a shock in one region can quickly spread, affecting investor confidence worldwide. So, what's next? The market will continue to watch oil, but it won't panic at every spike. Expect volatility, yes, but also resilience. As supply adjusts and geopolitical tensions evolve, opportunities will emerge. The key is strategic positioning. investors should focus on sectors with positive long-term growth prospects and consider diversifying into international markets to hedge against domestic economic uncertainties. Additionally, keeping an eye on technological advancements in energy efficiency and alternative fuels can provide insights into future market shifts. While short-term fluctuations are inevitable, the long-term trend will depend on how quickly the global economy can adapt to changing energy landscapes. Profit or peril? The verdict: the stock market's not at oil's mercy, but don't ignore the warning signs. Consider this a wake-up call to diversify and hedge your bets. A balanced portfolio that includes a mix of sectors and asset classes can mitigate risks associated with oil price volatility. Staying informed about global economic trends and maintaining flexibility in investment strategies will be crucial in navigating the uncertainties ahead. If you found this analysis valuable, hit subscribe and tap that notification bell. Stay ahead, stay profitable.